Hey everybody, this is James Pelton. I hope you all are doing well. I am a little bit under the weather. There is potential that it could be COVID. It might not be. I took an antigen test and it said negative, but then it said positives mean you have it, negatives don't mean you don't have it. So, and I feel terrible. And I was around people that have COVID. So we'll see. But I'm here today with Colin, and Colin, one of my best friends in the space. I love too that he comes at things just a little bit differently. Like he's big into stocks and dividends and that side of things, and I'm not really. So again, I like my audience to be well versed and get all this different information. I'm not saying you have to go do all these things, but I think you should be knowledgeable about what's out there in the stock market. Actually, before I met Colin, I had never heard of a covered call or a cash put or whatever it is, cash secured put. Yeah, I'm not even totally sure what that is. I assume it's like a covered call, but now I have a Webull account and I sold my first option. And so I'm excited about that. I bought Ford is the stock that I've been going with, and it's been going pretty well. But excited to talk with Colin about cash secured puts is the main thing. He has a new course out called Growing Your Dividend Kingdom. I want to talk a little bit about that because I think it's an awesome title. And I want to talk a little bit about VOO too. And
Okay.
VOO 2. There you go.
VOO 2.
VOO 2. So maybe let's start with VOO because I saw you're always putting money into VOO. Okay.
Okay.
And can you explain a little bit to my audience? And by the way, welcome to my audience. Please hit the like button for Colin. Appreciate you guys and hope this is educational for you and gives you some ideas of other places to spread. I know we're all drowning in cash right now in this market, so we're just looking for new places to put money. But hopefully, this is educational for you. Again, part of what we're trying to do is set ourselves up for when the markets turn around. We're in good places to make top gains there. So, Colin, can you maybe explain to us what is VOO? Is it dividend playing? Is it you just DCA in all the time? What's your end goal with VOO? All the things. Just tell us everything there is about VOO.
Yeah. So first things first, I do have a tattoo of VOO on my body. So
That's dedication, man.
I made a goal with my community that if I got $100,000 invested into it by the end of 2022, I would get a tattoo. And I'm a man of my word. And I hit the goal, so I had to get a tattoo. So I do have it on my leg. Small tattoo. It's not like
okay. What if it rugs?
Well, if VOO rugs, then we have way bigger problems on our hands. I'm coming to James's house and I'm hiding out.
Yeah, so you can stay in my basement or something.
Yeah. So VOO or VOO is the S&P 500. It's an ETF, so it's stock related. I know James is crypto heavy on his channel, but I'm talking about traditional finance, stock related, and it contains the 500 largest companies in the United States of America. So we're talking about Apple, Microsoft, Tesla, Amazon, all the way down to number 500, which is still a big company, just not the maybe one you know of, but it contains the 500 largest companies. It's an index. Well, it's an ETF that tracks the index. So basically, companies fall in and out depending on their market cap and everything. And it's just historically been a great long-term investment for the stock market. You're basically saying, hey, the 500 largest companies in America, which might change in the next 20 years, but I just want to buy the index that holds that, let it grow. Hopefully let it grow over time. Historically, since the 1950s, it's grown roughly 10% a year, which I know James is like, ooh, 10% a year. Yeah, but it's just been a good long-term investment. And even Warren Buffett says he thinks most people should just be in S&P because it takes away the stock picking. It takes away the, hey, is Tesla going to grow faster than Amazon in the next 20 years or whatever? It takes all that stuff away. And just buy the S&P 500, the 500 largest companies. I DCA into it every single week on my streams on my YouTube channel. I was doing $1,000 a week. I've lowered it because I'm doing some other ETFs too. So lowered it, but still buying it every single week. And it's just one of those ones where I'm not trying to time it and buy it at certain prices, just like I do with my Bitcoin. I just buy it dollar cost average every week, and it'll average out over the long run. So that's a little.
Can I ask what's the difference between an ETF and a mutual fund? This might be a basic question, but I don't know the difference.
Yeah, so there's a few differences, but the main ones is usually ETFs are cheaper and expense ratio is not always the case. But one of the biggest differences is with a mutual fund, they are priced at the end of the day. So when market is closed, then they price. And so throughout the day, you're not going to see your mutual fund go up and down like Bitcoin goes up and down in price or Tesla goes up and down in price. An ETF trades like a stock in the sense that, like, if I go on Robinhood or Fidelity or Webull and I look up VOO, which is an ETF, it's going to go up and down. It's going to be changing price every single second, where a mutual fund is priced at the end of the day. So it's not like you're going to, see it go up and down throughout the day. So it kind of takes away the mutual fund kind of takes away the seeing it go up and down in price, but there's also tax efficiencies with ETFs that aren't with mutual funds. So there's a lot of differences, but if you're looking at two different things, they're like, if it's a mutual fund S&P 500 or an ETF S&P 500, they're going to be pretty similar in terms of growth over time.
Okay.
And then ETF versus index. So this is a good confusion that a lot of people have, and it's a good one because I'm glad that you asked this, Davis. So if you look at an index, a mutual fund can be an index fund, and an ETF can be like an index fund. They both track an index. So like, for example, if we look at like an S&P 500 mutual fund and VOO, which is an S&P 500 ETF, they're both index funds in a sense because they both track the S&P 500 index. They're passively managed, meaning someone's not going in there like buying and selling on your behalf per se. They're just indexing or tracking the index, which is the S&P 500. So index fund is just like the overall blanket for a fund that tracks an index. In this case, VOO, tracks the S&P 500.
Okay, so you can buy VOO just on Webull or Robinhood, just like you would buy a stock. Pretty much, you just buy. You have a certain number of shares.
Yeah, so it's just like Vanguard is the one that has the fund. Like, they created the fund, Vanguard, but I buy my VOO on Fidelity, and I can just buy it like I buy a stock. So, I buy on Fridays. So on Friday, go in there and I buy $250 worth or $1,000 worth or 3 shares, whatever it is, buy it, and then I just hold it like I do with my Bitcoin. Basically, I treat it like I treat Bitcoin. Just buy it and hold it.
I didn't hold it. Okay, and does it pay a dividend?
Yeah, it does pay a dividend. It's not a dividend specific ETF, meaning like it doesn't hold just dividend stocks because it holds the 500 largest. It's going to hold like Tesla that doesn't pay a dividend versus like a dividend specific fund is not going to hold Tesla because it doesn't pay a dividend. So the yield is lower. It's like 1.6%, I believe right now is the dividend yield. So not like the highest dividend yielding ETF out there, but with my play with VOO is not necessarily like for the dividends. It's for the dividends, nice to get, but it's for the growth over the long term, getting that pre-tax hopefully 10% a year.
Yeah. Can I ask? So what's the end goal? Because one of the problems I have with non-cash flow. I mean, we were talking about this in a Sleep Money Club stream, by the way, and shout out to Sleep Money Club.
Yes.
But what's kind of the end goal? Because what I have a trouble with is, do you just keep growing it until you die, and then now you have a whole bunch? Like, do you plan on selling at some point? What's your plan with VOO long term?
Yeah. So I mean, the ideal outcome is to never have to sell it, in the sense that my dividend income from VOO will be enough to cover my expenses. Now, with that being said, like a VOO, for example, pays a 1.6% dividend yield roughly is the current yield. But you have like other ETFs that pay like above 3%. So you're going to obviously need more capital in VOO to get the same in dividends. But with that, obviously when the time comes, it depends on where we're standing, like where I'm standing with my money and everything. But the ideal outcome is have, multiple millions of dollars in there where it's paying me, 30, 40, 50 grand a year in dividends, which I know in the future it's going to be less buying power, but hopefully that's not, like I'm not only investing in VOO. So it's not like I'm relying just on that one, but it's just to let it grow over time. And if I have to, sell some and buy a different fund to get a higher yield, it'd be better to, let that grow over time and have a couple million to sell versus if I try to just get all this income today, but I'm not getting the growth, in ETF related conversations. So,
No, that makes sense. Is this AMA relevant to anyone outside of the USA?
Yeah. So, I mean, VOO is if we're talking about VOO specifically, it's I believe you can buy it if you're outside of the States. There might be some fees depending on where you're located. But with the cash secured puts, what I'm going to talk about in a little bit is also relevant to people out of the side of the US, as long as you can trade options in your brokerage, which not every brokerage can. So but it is relevant. People in the UK and Canada that I know sell options. It's just depending on your brokerage and stuff like that.
Yep. Is he running a fund we invest in or giving investment ideas? So he's talking right now. We're just education. One of the reasons I love Colin, he's a great educator. And he does have several courses that we're going to talk about. And what I love about Colin's courses, in fact, I've given him flack for this. Like usually these types of courses, I went through his course, which let me grab a link to it. It should be in the description. But I went through this course and I was like, I would expect to pay like, normally courses are $497 or $997 or $297. And he sells his courses for like bare minimum, basically just to cover his expenses, I think, for the time. And probably not even that, because they are very, very affordable. Let me just bring up the screen here so people can see. So, I mean, I keep encouraging him to raise the prices. So if you want to get in at $50, I would recommend you do it. Not financial advice, but 26 people, 26 5-star ratings. Everybody loves it. $200 that includes private coaching. I mean, that's crazy. So he's very smart, would love to give advice on that. So a link to that course up above. And people even get a discount with me, right? James 30, is that the promo code?
No, just James. They type
just
in James. Yeah.
Okay, so 30% off if you just use code James. So it makes it even cheaper. So if you're interested in covered calls or cash secured puts, definitely get this. And before we get into cash covered puts, so my last video we did covered calls. I do want to ask about your new course too, the Dividend Kingdom one, because that one I just really like that. So what's your strategy behind that one? Is it buying higher dividend ETFs? And then what kind of dividends do you expect on something like that?
So that is not necessarily talking specifically about what to buy, but more or less just helping you, the reader, learn about the strategy behind dividend investing and kind of how that can play into it and help paint a picture. So for example, if you're a younger investor like me, right? I'm in my early 20s. Now, with that being said, I've been investing for almost 8 years now. So, time frame, a long time to invest for my young age. But the strategy there is like, hey, if you're a young investor, sometimes like buying that 13% dividend yielding ETF is maybe not the best strategy because like there's more to it than just the dividend. So it's helping people formulate and understand like everything what a dividend is, what is dividend yield, what is a good dividend yield if I need the income today versus, hey, if I have 25 years to invest, maybe total return is a lot better than just getting a high dividend yield and not getting any return on my actual capital. So there's a lot of strategy that comes to and fro from that. And so building your dividend or growing your dividend kingdom is just showing you like, hey, here's the strategy, and then showing you math behind. If you just stick with it over the long run, you can be like James and your expenses are paid for from your investments, so.
Awesome. No, I'm excited to go through that, course and kind of, cause I would like to diversify more. So I hold just an index fund of some kind. I think it's a mutual fund though. But I don't really watch it or anything. I gave it to a financial advisor and they've done all that stuff. But yeah, I'd like to learn more about this. So thank you for doing this. Quarter Mile says 1 to 3% yield annually. That's just talking about the dividend on VU.
Yeah.
So VU itself will appreciate, like you said, on average about 10% a year. Now, some years it's going to be, 20%. This year is probably way down, I would imagine.
Yeah.
But it averages out to about 10%. So you can kind of think about it like real estate. Real estate has a little bit of yield, maybe a little bit more than VU does. But then what you're really hoping is for appreciation of the asset also. So there's like a two-pronged approach to growing your wealth that way.
Yep.
And this was a really good question. What makes you more money, crypto or stocks? That's a great question.
I mean, in terms, I know you below Tony, you said, returns wise. So in terms of returns, I mean, just on paper, you're going to get historically, you're going to get more returns with crypto. Again, historically, if you compare the S&P to Bitcoin in the last, 5 years or 7 years, Bitcoin outpaces tremendously. So in that sense, returns wise on paper, it's going to be crypto. The thing there is now, I see David says, depends on how many times you get rugged. So with that, it depends what you're investing into is really what matters more in that case. If you were to buy into what's like a strong nodes, right? Well, then your money, whatever it is gone, right? Or it's minimal versus it, but the same goes with stocks too. So if you compare, like, let's say, Carvana stock versus Tesla stock, and Carvana is about to go bankrupt, or maybe they already did. They can't afford their stuff. They're reselling used cars. Like, that depends on the stock you're buying, right? So it's hard to answer that question, that big blanket. But on paper, if you're looking at the two biggest like asset classes within each one, like Bitcoin versus the S&P 500, historically Bitcoin has outpaced. Obviously, way more volatility than the S&P. But again, it really depends on like exactly what you're looking at to compare that. Tony, hopefully I answered your question in a way. It's just hard to answer it when you're looking at just broad market twos like that. But
yeah, and in markets like this, if you've been chasing high returns, you're not doing very well. In fact, I'm doing a video this Friday. 13 projects that I got into in July, and only one of them is up from where I bought it in July. So, and 6 of them are at zero, and probably 4 of them are very low, and then there's a couple that are okay, and only one, MDB is the only one of the 13 that is actually up from in July when I got it. So, in that regards, shooting for maybe safer options might have been the right move with this type of market. And by the way, I love the questions, guys. I do want Colin to teach us about the puts, but I love the questions too. Do you think we should wait for a recession and market crashes to kick in? What are your thoughts on like timing the market?
yeah, so like for example, you said VOO might go down. So here's my thought on the market. This question is a good question because I get this question a lot on my streams as well. Is why not just wait for the market to go down, right? And if that theory worked, then I think most of us here would already be millionaires, right? Because we would just wait for, in 2020, we would have bought in March when the bottom was in. And so the thought process there, although theory sounds great, it's like, well, I'm going to wait for it to go down or it might go down. For me, again, this is assuming you have a long time horizon, you're a longer term investor, you're not looking to trade, right? I'm talking about just buying and holding investors or longer term investors. Mathematically speaking, you're going to, and historically speaking with data, it's no one can time the market, right? No one can time the market. We know that they can't. So you're saying it might go down. Well, let's say it doesn't go down, and let's just assume today was the bottom of the market, where like these prices were never seen again. It only went up, but you were waiting for next month to be lower. Then you would have been better off buying today. So my answer to your question is to like reframe it. And I'm going to like challenge you on the other side is like, well, what if it never went back down? What if it only went up? You would love to buy today, right? And compared to where it was 2021, like if you were, this is the best way to put it like this, and I'll put it crypto related. If you were buying Bitcoin at above 50,000 and you were like, I am so bullish on Bitcoin, or if you were buying Ethereum above 3,000, you were like, I am bullish on Ethereum. And then now Ethereum's at, what is it? 1,200, 1,100 and Bitcoin's in the teens. And you were buying at those high prices and you were loving it then. And if the only thing that has changed about that is the price, you still are bullish on Bitcoin, then you should really be loving it, buying it today. And yeah, could you maybe get Bitcoin from, what is it at today? 15 or 16. You could have got it for 13. But unless you're buying in large amounts of money, like I'm talking about like hundreds of thousands or millions of dollars, if you buy $100 of Bitcoin at 15,000 or $100 of Bitcoin at 14,000, your returns aren't going to be like over the long term aren't going to be that much different on that $100. It might be an extra 20 or 30 bucks, which might, for some might be a lot of money, but over the long run, it's mathematically not going to make a big difference because you're banking on it going down to 14 or whatever it is. So that's a little pushback on your question there, seeing it that way.
Yeah, and I'll just add in too, from my experience, no one successfully times the market. It just doesn't happen. Now people use TA, but like, because I used to, for a while, I was thinking, oh, you should wait till TA dictates it's a buying zone. But then I'll watch 2 TA people, and one says we're in a buying zone, and one will say we're not. And so you're just like, well, what do I do now? And I don't know TA very well. And so, yeah, from my experience, if you're not, the safest thing is just DCA. Don't consider the price. Just, hey, if I believe in this in 10 years, if I think it's going to go up 10%, on average for the next 10 years, and that's what I'm looking at, then you want to do that. But if you're looking for 1 year, then yeah, you might want to time the markets a little bit. because you're not going to be able to have that long-term average. So yeah, thanks for answering that. All right, well, let's get into cash secured puts. So we know covered calls. Colin, tell us about cash secured puts and how we can make some money from those.
Yeah. So if you all remember, like a month or so ago, I was back on James's stream, and we were talking about covered calls, which is where you owned 100 shares of the stock, and depending on where the price went, you could say, hey, I'm okay selling my shares at X price, and you're gonna get paid to do this or paid to do that. Covered cash secured puts is the other side of the game. So you have covered calls where you already own 100 shares. Cash secured puts is where you don't own 100 shares, but you might want to buy 100 shares of a stock. So for example, we can go to Ford, right? So the current price of Ford is at $13.42. So to buy 100 shares of Ford right now, if we were just at market, to buy 100 shares of Ford would cost us $1,342. But let's say, actually, I would like to buy Ford, but I want to buy it for $13 a share, right? So 42 cents less than where it is currently. You can do what is called a cash secured put, where you put up $1,300 in cash, because $13 a share times 100 shares, because remember, options are in 100 shares, is $1,300. So you're putting up $1,300 in collateral, and you're saying, if the price of Ford goes below $13 a share, I will buy it for $13 a share. And because you're making that promise, you're going to get paid a little bit of money to agree to buy those shares on a by a certain date, the expiration date. So just like with the covered call, where you said, hey, I'll sell my shares at a price in the future, and you're going to get paid money. With the cash secured put, you don't own the shares yet, but you're saying, I'd be okay owning the shares in the future, 100 shares of whatever stock you're looking at. And for making that promise, the buyer is going to pay you a little bit of money, because you're the seller. You're going to pay you a little bit of money to make that sell. Now, that premium, that money that you're going to collect, is yours to keep. So let's say James does this with Ford stock. He sells a cash secured put. He has $1,300 in his account, cash, sells a cash secured put on Ford at $13 a share, puts up the $1,300 in collateral. Let's say he gets paid, I don't know, it would be, let's say 1%. So $13, right? Which is, 1% on your money for that week. He can go and buy his kid a new Beanie Baby or something. That money is his. The income is his to keep. He doesn't have to turn it back. Like you said, Tony, insurance premium. It's basically just like, you're not going to get it. The buyers don't get it back. We are the sellers. We get to keep it. There's no one coming into our pocket to steal it from us. We don't have to send it back or anything like that. So that's a high level view of a cash secured put. I'll pull out the whiteboard if there's some questions. But basically, the easiest way to explain it is this. You want to get into a stock, and this is how I see cash secured puts. I want to buy a stock, Tesla stock, Amazon stock, Apple stock, QQQ, right, which is an ETF, whatever it is. I have cash collateral. That's where the cash secured comes into play, cash secured puts. They're not naked puts where you don't have the cash. They're cash secured. You have the money, and you say, hey, I want to buy 100 shares of whatever stock it is, but I want to pay a little bit below what it's currently trading at. And this is a great strategy. I can't remember who asked the question. Mountain Brother Productions. This is a great strategy to get potentially, there's no guarantee, but potentially get that stock or that ETF for a lower price than where it's currently trading at. And if you don't, you're still going to get a little bit of premium. Like Tony said, insurance premium. You're getting a little bit of money in your pocket to make the promise to buy it for cheaper. But again, there's no guarantees that it does go below that, and you have to buy the shares. If that's the case, if it doesn't, you just get your money back, you get your cash back, and you get to keep the premium.
Okay, very cool. So is this most helpful if there's a stock that you want?
Yeah, and I'm kind of like, I'm glad we're doing this stream here as well, because it kind of like, if people in the chats were in the covered call stream, this is called the wheel strategy. So like the one end of the wheel is the covered calls, what I talked about last time, and then today is the cash secure puts. And so yeah, like, hey, I would love, let's say for example, Tesla, right? I would love to own Tesla. It's trading at $160 something, just say 165. So if I would have to spend $16,500 to buy 100 shares, but you're like, you know what, I want to buy Tesla, but I only want to pay 160. And so I can, hey, I like it. I want to own Tesla, but I want to pay 160 a share or 16,000. So I'm going to do this and get paid, 150 bucks, $200 for the week to promise that I'll buy it at 160. The risk here is, and I want to make sure, clear the risks. The risk here, there's two sides to the game. Number one is in that example I just mentioned with Tesla, it's at 165. You say, I'll buy it for 160. So you sell a cash secured put, buy, and you choose expiration for the next Friday. So 1 week away. Let's say Tesla goes to 180. It never goes below 160. Well, then mathematically, you've been better off just buying Tesla at 165 and getting the appreciation from 165 to 180 versus saying, hey, I'll buy it at 160, right? So you miss out on the gain if the stock goes up in value. The second risk is, and this is kind of what Mountain Brothers asked too, what happens if we buy it when it goes below 13? So when you're selling a cash secured put, and let's say a Tesla example, we say, I'm going to sell it at 160. Let's say Tesla goes down to 155. It's expiration day. You have to buy, you're contractually obligated to buy the shares at 160. So then you're immediately down $5 a share or $500 in cash. Now, that's why it's important if you're going to sell cash secure puts to do it on a stock that you actually believe in and you want to own, because in that case, you're immediately down $500, right? Because you bought them at 160 when it's at 155. Now you have to factor in the premium that you collected or whatever, but that's kind of the downturn there is like, if it does go below, you're contractually obligated to buy at that strike price that you already selected. So that's kind of like the up and downs of the risks.
Right. But if you're believing it long term, that won't matter as much because you're not planning to sell that week. So this wouldn't be something you go in and do every week. Probably it's more of an accumulation tactic, right?
Yeah. So like when I did the covered call thing, I was talking about buying 100 shares and then like you did on your Weeble with Ford, right? What I like to do is, let's say Ford is a stock I want to sell options on, right? But I don't want to go and spend $1,300, $1,344 to buy 100 shares. I want to get into it, but I want to get into it for cheaper. So I'm going to, instead of just going and buying 100 shares at market and selling covered calls, I'm going to go, this is what I do is I sell cash secure puts to try to get those 100 shares for cheaper than where it's currently at. And then once I get the 100 shares, let's say I do it at 13, it falls to $12.96. I get the shares at $13. I can turn around the next week. I own the 100 shares now and sell a covered call at $13.50, right? So my average cost is $13. If I would have bought it at market, it would have been $13.44. Now it's 13. I can sell the call at $13.50. And if it goes above, now I'm on the call side. Sorry if this is a little too confusing. I'm on the call side now. And let's say that week it goes to $13.60. I'm getting 50 cents a share in appreciation because my average cost is 13 plus the premiums I collected on both sides.
Okay. No, that makes a lot of sense. And if this does sound complicated to people, again, he offers this super cheap course. What's 30% off of $50, $15, whatever?
Yeah, I think it is. Something like that.
Yeah, something like that. We're not good at math. We're good at finances, not math, But so it's like $35 and it's an extensive course. Like there's quite a bit of content in it. Ian says, Colin, we need the whiteboard.
I'll pull out the whiteboard.
Let's see. Chance says, I'm looking at cash secured puts as a limit order with the premium bonus. Would you agree?
Yeah, Chance, that's a fair way to say it. I would say that's a fair way to put it, to explain it. Okay. So I'll pull out the whiteboard for you, Ian.
There you go. We get teacher calling.
Yeah. So I'll explain it this way, kind of with the numbers, right? So let's use Ford, for example, right? So we're looking at Ford stock. Ford stock here. Currently priced, this is the current price of Ford, right? It's going to change as throughout, but this I'm looking at on Robinhood, $13.44. So let's say you have cash on hand is $1,300. Well, sorry, let's go like this. $1,300, right? Well, right now, mathematically, you can't buy 100 shares of Ford, right? Because you only have, it costs you $13.44. So you can't even buy 100 shares of Ford. But what you can do is you can sell a cash secure put, CSP, cash secure put, at the $13 strike. And let's say expiration, meaning after this date, the contract becomes void, would be next Friday, which would put us at the 23rd, I want to say. Next Friday is the 23rd. Yeah. Dang, next Friday is already almost Christmas. I know, right? So expiration is 12/23. So what this is saying is you're putting up $1,300 in collateral because options are in lots of 100. So it's 13 times 100. So you're putting your $1,300 in collateral up for this contract. And I'll give you go ahead, James.
Teacher. Do you, for cash secured puts, do you also need to do 100 shares?
Yes, options are in lots of 100.
Okay.
So it will be 100 shares.
So any options that you do will be at 100 shares.
So yeah, no problem. So right now, looking at this is actually on the options chain for next Friday. This is going to pay you 16 cents. Now hold your horses. That doesn't sound like a lot of money. Remember, it's in lots of 100. So it's going to really pay you $16, which again doesn't seem like life-changing money, in terms of you're putting up $1,300, but you do the math, that's over a 1% on your money, right? 16 on 1,300 is 16 on 1,300.
1.2%.
1.2%. Yeah, for 1 week. So let's go. 1.2%, right? So look at percents, not dollar amounts here, okay? So you're doing 1.2% on your money for the week. Here's the outcomes, okay? Outcome number one is the price of Ford stays above $13. So let's say on next Friday, 12/23, let's say Ford is at $13.28, just above 13. What's going to happen is you will get your $1,300 in collateral back, your cash back, plus you have the $16. So now you actually have $1,316 in cash. Okay. You don't own the shares, but you get your cash back. That's number one. Outcome number two is, let's say the price of Ford is below $13. What that happens there is then you are contractually required to buy 100 shares. So you have your 100 shares of Ford at $13 average cost. Sorry, that's hard to read. Let's go. Likes are better than apples. I agree. So you have your 100 shares at a $13 average cost plus your $16, right? Because your premium is always yours in your pocket. So you always will have your premium is yours no matter what. Now, so that's really the two outcomes. Like it's either above or below. If it's above with a cash secured put, you get your cash back and you keep the premium. If it's below, you get the shares. And this happens automatically. So like over the weekend, it will buy the shares for you. You don't have to go and buy stuff. You will then on Monday morning at market open, it'll say you own 100 shares of Ford. Your average cost is 13, plus you have $16 of cash in your account to, like I said, take your wife to McDonald's, because I don't know what you can buy with $16 anymore.
Right.
But, so that's like a very high level and visual of how a cash secured put works.
So again, the risks that you're talking about are if the price of Ford goes up to $16, then you would have been better off buying 100 shares last week, and then you would have made a lot more than the $16. And if the price goes down, then you'll get your $16, but you might already be down $100 or something like that. So kind of ideal situation is the price is right at 13 when the option expires. So that would be like the ideal situation.
Yeah, when it gets right at 13, and I saw Davis ask that question too. What happens exactly at 13? It depends on what the buyer, if they want to execute that or not. So it depends on that end.
Okay. And then Jack would like to know, do you know what brokers can do this in the UK?
Yeah, I know a lot of people like Interactive Brokers that in the UK. Interactive Brokers is the one that I'm most familiar with that people in the UK use.
Okay. And I love this. Davis says, this is complex. Can we get cash secured puts JP NFT? And we'll see. I have some questions too about because I just started doing the covered calls, and I have a couple questions about that I want to ask too. But Ian says, Colin is a great teacher. My pension has 40K pounds. That's the pound sign, right? This
Yeah.
year, thanks to Colin. So congratulations to that.
Nice, Ian.
And then what's the lowest investment for 100 shares? Which share would you recommend us to start with? And so the reason I went with Ford, and Colin, I'd love to hear your take on this, is because I wanted to start with about 1,500 bucks, but I also wanted to do like a top 100 or top 500, because you don't want to do a super low stock that could, some obscure stock that could go out of business or bankrupt or something. So when I looked through like some of the top companies out there, Ford was at $13 or $14, I think, when I got in last month or whenever. So that fit into what I was doing. But is that how you look for them, Colin?
Yeah, I mean, the biggest thing with options and selling options in general, both covered calls and cash secure puts. So when I say selling options, it's both sides of the things. The underlying stock is the most important factor. And so, like James just said, if there's cheap stocks there you could do for $2 or $3 that's going to cost you $200 or $300 to get into, but truly, it rests on what the underlying stock is. So if you're going to do it on some penny stock that, a $3 stock that's a company that's just really small cap, no one's heard of them and they're really risky, that is risk, extra risk you're taking on versus like Ford, right? Like I mentioned, there is risks with selling options on Ford with the price and whatnot, but as a company, right, nothing's unlikely anymore, especially, but Ford has probably a less likely chance of going bankrupt than some startup company that you're selling options on. Or, Tesla has a less chance of going bankrupt than a startup company that you're doing. Not to mean that Ford and Tesla can't go bankrupt, but that underlying company is a little bit stronger than some random startup company.
Yeah. The Quarter Mile says, can you simply say you want to buy at an unlikely low price and simply collect your 1.2% weekly? And so I can help answer that. I always feel so smart, but whatever price you pick is going to be the less likely it is to happen. Like if you picked $1, no one would pay anything for that put because they know it's not gonna happen. So Colin, do you want to expand on that?
Yeah, no, I mean, you said it perfectly. The easiest way to explain like options, and this I like to use, is like imagine I'm trying to sell James a trailer, right? And James wants to buy the trailer from me. And as the seller, I'm trying to get the highest price possible. And as the buyer, James is trying to get the least price possible. Well, there's an implied floor. Like James isn't gonna that I'm gonna sell it at, right? And there's an implied floor that James is gonna, or ceiling that James is gonna pay. So there's a range bound. So as you get closer, as your strike prices, and strike prices are like the stock price itself, as with cash secure puts and covered calls, as you get closer to the actual share price, the more percent return you're going to get, but you're also taking on more risk. So the more risk you take, the more return, just like with anything.
So here's my Webull account. I'll just kind of show people. I think sometimes that's helpful. So for the calls, like there aren't any, because the Ford has been kind of trending down. So there actually aren't any calls available. I mean, you'd lose money on a call so the only calls available are if the price goes down. Does that ever make sense to do on the covered call side of things?
I mean, it could, let's say by next Friday, you think, let's say Ford has earnings or something, and you're like, they're going to horrible earnings. It's not gonna be good. And the stock price is going to plummet by $1. So I might sell the 13, but again, the risk there is if it doesn't do that, then you're contractually obligated, and there's ways out of it, but you're contractually obligated to sell those shares at 13. So, I mean, it could make sense, but the thing there is like, it's a lot of risk.
Yeah. So for example, this is just 3 days away. Webull doesn't let you do 7 days. They do like by week. I think
every Friday. Well, every stock is every Friday. Or most stocks are every Friday.
Okay. So, yeah. Gotcha. But like, for example, 3 days away, if I'm willing to sell at 11 bucks, they'll give me $25 to make that, or $250.
Yeah, $250. Yeah,
to make that happen. But the odds of Ford going from 1347 down to 11 in 3 days is not very high. So that's why they're willing to pay so much to get that option. Because it's just not, it's likely I would lose money on that because it's so close and that's such a big difference. So that's kind of how the pricing here works. If I go closer to the strike price, like if I'm willing to sell for 13 bucks, I'll make just six bucks, right? Yes.
Yep.
Yeah, $6. And so, and if I think the price, if I want to sell an option for higher, I have to pay them basically to make that happen. So cool. And then, so how do the puts work like on Webull here? Is it, I was trying to read. Sometimes the charts and everything are hard to navigate around. Like it took me forever to find. You can't go to the trade. You have to go to the stocks. That's where the options are in Webull. But do you know how the puts work on here?
Yeah. So you'll want to sell like a put for below. When you're selling puts, you want it to be below the current share price. So the share price right now is $13.46. So you'd probably want to sell like the 13 is going to be your closest strike. So if you scroll down a little bit, yeah, so like the $13 one, right? So it'll pay you, $6 for that on your $1,300 in collateral, which is about a little under 0.5% for the week. And then you would go over on their side where it's the buy is green. You click over on the sell side. Yep, and then limit or market, whatever, hit sell, and then it'll fill. You're going to get paid whatever it's going for. So right now it's going to be like $6.
Okay, gotcha. Yeah, and again, for people, this is the same as in crypto, so I know this part. But limit means like there's a certain price that you want to do it at. So like it's trading at 13.44. So if I put in, yeah, and actually that's the limit price for this put, correct?
Yeah. So the bid is what buyers are willing to pay. Ask is what the sellers are willing to sell it for. Okay. So if you want it to get filled, you would go where the bid is, because that's like the trailer thing. Like if I'm selling James a trailer and he's like, I'll buy the trailer for 7,000, and everyone's only selling it for 8,000, and I come and say, yeah, James, I'll sell it to you for 7. Then you're gonna buy mine because mine is the cheapest one for you. So if you want it filled, you go 6 and collect your $6.
Gotcha. Okay, very cool. Jack says covered calls and cash secure puts. What's the difference? So the difference is just which side you're doing. So either you're selling the options or you're buying the options. So it's just which side of this that you wanna do.
Yeah, and Jack, like with the covered calls, you own the 100 shares. With the cash secure puts, you don't own the 100 shares. You have the cash. So that's where like the cash secured name comes in. So with covered calls, you already own 100 shares. With cash secure puts, you don't own 100 shares, but you'd be willing to potentially own 100 shares.
Okay. And then MBP says, can't we leverage our capital and enter multiple trades?
I like just in general, or like if you're saying margin, I mean, I don't recommend margin personally, but you're saying just in terms of like doing different stocks. Yeah. Like I sell options on multiple stocks. So you don't have to like you have to own 100 shares or have the cash equivalent of 100 shares. But yeah, like I sell options, both calls and puts on multiple stocks.
Yeah. And yeah, I will say if you're just doing one stock, you might get kind of bored, because like I'll hop on and check forward, and like none of these I want to really sell. Like it's not what I'm wanting. And so I wait until Ford's more on an uptrend, and then there's better calls available. But I have done a couple already. So, and I made a little bit of money, but then the price of Ford went down. So then my gains were kind of erased in that. So there's a lot of things to kind of think through when you're doing that.
Right.
Can you do this also on forex, like gold or silver?
I don't know, Davis. That's a good question. I know you can do it on crypto, different routes. Like you can't do it on Robinhood crypto, but there's different protocols that allow you to do it on crypto. I don't know for forex. I don't have an answer for that.
Okay.
I don't play around with forex. I don't know.
Yeah. I was unable to get the broker name. What was the name of the broker that you've heard about in the US?
Yeah, Interactive Brokers. Interactive Brokers. Yeah.
Then people definitely need to understand assignment risk.
Yeah. So I mean, the thing there, Josh, is it's why it's important. I kind of said earlier is to sell options, and specifically in this case, cash secure puts on stocks that like you actually are okay owning shares into, because like let's say you sell puts on Tesla, for example, and let's say you sell it and you get assigned shares, and then Tesla goes down because something happens with Elon, or he buys another social media thing and it goes down even more, whatever it is. Yes, they're like, that's why it's important to own shares or sell options on stocks that you're okay owning in. And there's still like risk there as well. I mean, it's as investing at the end of the day. Like, whether you're buying and holding, or you're investing, selling options, or you're doing crypto or commodities or whatever, forex, whatever it is, there's always risk. Like nothing's risk free in anything. So definitely understand, it's important to understand all the risks.
Yep. And in general, the amount of return you're going to get is going to be reflective of the amount of risk that you're putting in. And the reason that is because of how the economy flows, where if there's a really low risk thing that gets a huge return, everyone goes over to it and that makes the return lower. And so how the markets work is if you just give them enough time, eventually the amount of APY you're getting is pretty corresponding to the amount of risk that you're taking out. Now, the exception to that is if you're getting into new things. That's why crypto's, to me, is a little bit out of whack because the markets haven't fully caught up where the return you're getting from like Bitcoin or something like that. Not everyone has discovered crypto. So to me, crypto is like a little bit out of place where you get a little less, you get a higher return than the risk you're taking, which is why I like crypto a lot. But in general, you can look at if I'm getting a 10% APY in VOO, that's about the amount of risk you're taking is a 10% a year type of risk. So you compare that to the 10,000% return you're getting in like drip or something like that. Much lower risk in VOO, and it just corresponds with the when I did some research on covered calls and puts, most of the people I saw said they shoot for about 7 or 8% a year. I think Colin probably hits a little higher than that, and you have to be it's not passive, so it's a more active thing. But I like to just know it at least.
Yeah.
Andy says, can you create straddle with that?
Yeah, I've straddled a few times, which is basically you're selling a call and you're selling a put. And you're basically saying you're collecting income from the upside of the shares you own. And then you're also like, yeah, I might be okay buying more shares. So I'm going to sell some puts too. And the ideal outcome there is that stock stays in between your strike price for your call and your strike price, for your put. So yeah, you can create straddles. I just do them manually, but yeah, you can just sell a call and sell a put and create a straddle. On that.
Can I ask you, Colin, as like a traditional investor, my experience is it's very hard to outsmart the market. So everybody thinks, oh, I've got this strategy that no one else knows that's going to make a ton of money. And in general, like I've just found, no, that's like, if there's a strategy, people have seen it. And the wealthy people, especially who are spent all day looking for ways to make money, they've found most of these. So don't think that you can like outsmart or try all I found this loophole. I mean, I don't think that there's loopholes in options tradings of that, like, oh, nobody knows about this and things like that. And that's why I like you, is you're a very principled investor and just, hey, long term, I'm going to just buy VOO. I'm going to, you have your different strategies, and I really appreciate that.
Yeah, I mean, like with that, James, I'm sitting here, I'm saying, I shoot for 1% a week, and then someone's gonna do the math, like, okay, 1% a week is 52% a week, or 52% in the year, and that's like, great, whatever. And I really do my best to try not to extrapolate that 1% a week out to, if I'm getting 1% this week, I'm gonna get 52% for the year, because like, if anyone did that, they're going to be like the greatest investor known to man, right? Like 52% a year for what, it's just crazy. Even the greats don't do that. And so to me, it's not like trying to, beat the market there. And like, I'm not trying to necessarily beat the market. I'm just trying to use what I'm owning and create a little bit of cash flow from that. And you can go like, when you're selling options, and I explained this in my course, like you can go more conservative and go like, maybe you get 0.1% for the week, which is like not crazy compared to someone doing like 0.5%, but you're still creating a little bit of cash flow on your investment. And when you're doing that, your strike prices are a lot further away. So your chances of getting assigned or called away are way less. And you're being way more conservative. Or you just simply buy and hold. Like I have a portfolio I buy and hold. And like, I'm not saying this strategy is for everyone. It definitely takes consistency and, building a strategy that works. And there's risk, in everything. And that's why preface by saying I have about 10% of my total investments in a options trading portfolio. I don't go all in. I don't invest all my money in options because I know there's risk, but it's there's certain things you can do where it's like, maybe I can make a little bit of extra cash flow by doing this,
Yeah, absolutely. And I think more than strategy, it's the mindset psychology that's important. Would you agree?
Yeah, it's definitely psychology. mindset, and in the last part there is consistency. And so, unless, again, this is not like a options trading short-term thing where, you go on YouTube and you get the ad where it's like the guy in the Lamborghini being like, I just turned a $500 Amazon call into 50,000. And that's not what this is. I'm not coming here and no one does this strategy to turn 500 into 50,000 in a week. That's just mathematically not going to happen by selling options. But for me, it's a long-term consistency, hey, extra $13 this week, extra $13 next week, reinvest it. Over time, it can become a very, very powerful thing, but you have to stay consistent and, again, understand like the risk and build a successful strategy with it.
Okay, very cool. Can you just briefly here as we kind of wrap up, can you talk a little bit about your Dividend Kingdom and what that course covers and kind of your strategy with that? Are you DCAing just into a high dividend ETF, or what's your strategy, and what kind of returns can you expect with that compared to VOO or compared to covered calls or something? You just want to talk a little bit about that?
Yeah, good question. So that course is basically just explaining how to, build a long-term successful dividend portfolio or kingdom, I like to call it. And successful is relative because, success maybe in crypto is, 100% returns in a year. Success in a dividend portfolio is buying good quality ETFs for companies that over the long term are going to continue to be around, are going to continue to pay dividends, and hopefully continue to increase their dividends. So every single year, your dividend income, which is one of the most pure forms of passive income, is growing, right? And so eventually one day, that dividend income can be something that you live off of, can be, pay for your bills. Maybe not all your bills, but hey, it gives me an extra $1,000 a month in retirement where, that's $1,000 more and I'm not touching the principal. It's coming from the dividend paid out in the company. Now, in terms of returns, it's a harder answer because you're looking at not only like the dividend they're paying out, which you can look at that and kind of compare like, hey, Exxon, which is an oil stock, pays a way higher dividend yield than Apple, which is a tech stock. Apple pays less than 1%. Exxon pays, I don't even know, 6 or 7%, something like that, dividend yield. And so you're going to, in terms of dividend yield, Exxon looks like a better investment because it's paying a higher yield. But when you're looking at this, you also have to look at the growth of that share, like the actual stock itself. So over the last 5 years, Exxon has probably been on a downtrend or at least flat. So your actual capital hasn't grown. But with Apple's up like hundreds of percents in the last 5 years. So just kind of like the course and explaining is just compiling all this information about dividends into, presentation and a PowerPoint and me walking through and explaining all this stuff and helping it. So like, hey, again, like the name of my brand is Decade Investor. I'm not looking to turn $10,000 into $100,000 tomorrow. I'm looking that, hey, if I stay consistent with my investments and I, every paycheck I get X amount of money and I put 10% away into whatever, ETF, stock, whatever, over the next 10 or 20 years, it can be something very, very valuable. And then I don't have to worry about my investments. I don't have to sit behind a screen and trade. I can go and focus on making more money. Then I will make more money. I can put in this, and then that's working for me on the back end, right? So at the end of the day, like this is what I try to reinforce when I'm talking about this stuff is, how James invests is different than how I invest versus how maybe, Sam, you invest, and Jack and Josh and Andy and everyone in the chat. We all probably have different strategies that we follow, but at the end of the day, we all have the same goal, right? Our goal is to not have to worry about money but more importantly, give us freedom. So we can wake up every day and, hey, my boss told me to come in on this Saturday, but like, I just don't want to go. And like, I don't have to go because financially my bills are paid for from my investments. Like that's should be everyone's end goal, is like the optionality of life, right? Freedom to do whatever you want to do, go wherever you want to go, be friends with whoever you want to be friends with because you're not strapped to go into a job Monday through Friday, right?
Yeah.
How we get there is different, right? Everyone's going to get there different way, starting a business, working 9 to 5, side hustle. Everyone's going to get there differently, but we all have the same goal. And so I'm just, speaking on things that I do and share my strategy of like what it's going to take for me to get to where I want to be. You can use it and like it and do it, or you learn it and you're like, I kind of like the crypto stuff. Great. At the end of the day, we're all have the same goal. So we should all be cheering each other on.
Yeah. Amen. And I think sometimes when people watch my stuff, there's an imbalanced, my videos are imbalanced to what my portfolio actually is, because I actually have more in the stock market than I do in crypto. But people, but I can't get on and make a video about, oh, I DCA'd into an index fund. Like it'd be a
Right.
terrible video. I mean, I know you do it, and it's actually not. It's good how you do it.
No,
Uh,
for your audience, I know what you mean. Yeah.
yeah. And so there's people think, oh, he's all in on crypto, but it's actually about a third. I have about a third in real estate, a third in the markets, and then a third in crypto. It's kind of about how my portfolio is designed. And the way I think about it is my crypto stuff is mostly short term. Like I'm just like, I don't think your 1%, I'll just use drip as an example, but your 1% a day from drip, I don't expect to get that for 50 years, right? Because I would be a multi-trillionaire if I compounded 1% a day for like 10 years.
Right.
A lot of those crypto calculators you see where they say, hey, if this 10,000% APY lasts for a year, we'll be, you know, multimillionaires. And it doesn't work that way. So I have a little bit in my short-term bucket. I have a little bit in my midterm bucket. And then I would consider, you know, the VU to be a long-term bucket where, hey, over the next 5 years, this might not even be up. But long-term, it definitely will be. So,
yeah.
Well, let me go ahead and close with, I just one more plug for this. I would not recommend that you start covered calls and cash secured puts after just watching this video. It's actually, there's quite a bit more to it, and it's hard in an hour video to get across everything. So I do recommend this course. I went through it, learned a lot. Even if it's stuff you don't immediately put into action, at least you know it, and it just adds to your toolbox of financial tools. I'll say that. So yeah, thank you, Colin, so much for putting this together. Thank you for what you do for the space. I think I'm always amazed, just like most people, most young men, I will say, are in get rich quick mode, and it does not serve them well. And that's one of the things I want to do is help bring on young men like yourself who are not get rich quick, but they're more disciplined, and you're starting to develop quite a portfolio. And it wasn't fast. Like you said, you've been going 8 years at this, but you're way far ahead of where most young 20-year-old men are because of your disciplined approach for the last 8 years. So
yeah, something like the last thing there too is like if you look at that, right? Like when you go get rich quick, right? You're taking a lot of risk. We all know that, right? Like that's the only way you get rich quick is taking a lot of risk. And I would personally, my analysis is, and I know there's a big step here, which is having a large investment portfolio, which takes time. But my thing here is, right, like let's say, you know, my portfolio is around roughly 200,000, right? A little over 200,000. So let's say if I can get 10%, which is in terms of like a high risk thing is, you know, let's see S&P, right? 10% on 200,000 is $20,000 of growth for the year. I would have to, that means if I had, let's say a $10,000 portfolio and I'm taking on all this risk to get the same returns, I would have to get a 200% return, right? So at me, like when you get a big portfolio, and big is relative, right? Like I know James is, I'm not saying like this, a big 200,000 for what I have. My thing is like, I don't have to take on a lot of risk to get good returns because there's the massive principal there. So my strategy is like, can I just get as much money in the principal and then I can take on lesser risk and still probably out return someone who has 30,000 and they have to get a 66% return for the year. And they get a 66% return, as James mentioned earlier, you're going to get a lot of risk because where there's risk, there's reward, but there's also, hey, I might lose all my 30,000. So that's kind of my strategy with everything I do. It's like just principal, big it, and then move it on and, you know, take on the lesser risk in areas and still get good returns.
yeah, nope, absolutely. And again, this is the spreadsheet that I use. I just want to show this real quickly, and then we'll call it a day. I might go take a nap. This I'm getting,
you gotta get healthy,
dying here. Let's see. So yeah, so here, this is the way I kind of think about it is like these degen plays, they can help get a jump start on your portfolio. Like in order for me to get my 15K a month I need for my living expenses, I have to have $2 million in a CD to make that happen. And you might not have $2 million, and it might be 50 years before you can get that. So I'm not saying put all your money into degen plays, but it can help speed it up. But you have to make sure to get out of the degen plays and start getting your money into these safer buckets, because before too long, you might get 40% for a few months, but then you're going to lose it all. So my goal is, hey, get in early, get my initial out, and then I can start transferring up into, and I put the stock market probably somewhere around here, probably maybe on this side of real estate. Real estate's a lot more active, but I mean, somewhere around real estate would be, I'd put stock market somewhere in here. And so that's the way that I think about money is I'm just, okay, I'm doing these high risk plays, and these are the exciting ones that most of my videos are around, but they're not where most of my money is. And I'm looking to get into, like, you might put Bitcoin here as a safer one, and we'll put the stock market here. And so it's like, okay, I'm going to take my Project 79 money and buy Bitcoin with it, and or buy stock market with it. So this is how I think about it. And hopefully that's helpful for people. But Colin, I appreciate you. Appreciate your education. You're a good teacher. So keep it up. You're a good YouTuber. Everybody go subscribe to Decade Investor if you aren't already. Thank you guys. And yeah, I'll take a nap and hopefully feel a little better. And we'll talk to everybody later.
Yep. Take care, guys. Thanks for having me, James.
Thanks.